Silver just rocketed 22% in 24 hours, $65 to $78. Bitcoin reclaimed $70,000 after dumping $11,000. $340 billion added to the crypto market in a single day. Over $1 trillion flooded back into U.S. equities in 2 hours. The Dow Jones hit a new all-time high. The Russell 2000 added $100 billion and turned green on the weekly chart. Every single risk asset on Earth moved in perfect synchronization. That's not a market. That's a script. And if you think this bounce means we're safe, you're not paying attention to what just happened beneath the surface. Because this wasn't a correction. This was a liquidation event. And liquidation events don't end until something breaks. Let me show you the pattern. Same sequence, same outcome. Every single time. Silver went to 65 yesterday. Lowest point of this correction. Right now it's 78. That's a 22% move in less than one rotation of the Earth. You won't see that on CNN. You won't see that trending on Twitter. But it happened. And it happened simultaneously across every asset class that matters. Ethereum surged 18% from 1750 to 2000. $550 million in short positions liquidated in crypto alone. Small caps outperforming large caps. Altcoins outperforming Bitcoin even while Bitcoin was bleeding. Higher beta assets showing strength while the foundations crack. This is the signature of a dying system trying to convince itself it's still alive. Now, here's what they're not telling you. The silver lease rate in London just jumped to 6.1% for 1 month. Let me translate that for anyone who doesn't speak banker. When professionals are willing to pay 6.1% just to borrow silver, it means physical metal is disappearing. If supply were abundant, if the crash was real demand destruction, lease rates would be collapsing right now. But they're spiking. Because what you just witnessed wasn't a collapse in physical demand. It was a flush of paper leverage, futures contracts, derivatives, synthetic exposure. All the fake silver that doesn't exist got margin called into oblivion while the real metal vanished into private hands. The silver CEO index is now at 106.35 and rising. Silver remains in backwardation, meaning spot prices are higher than future prices. That's not supposed to happen in a normal market. That only happens when physical is tight and getting tighter. Let me give you the COMEX data, because this is where it gets biblical. Total open interest in COMEX gold fell to just 400,952 contracts on Thursday. That's the lowest daily total since December 14th, 2018. 2 weeks ago, it was 555,000. What does that mean? It means the speculators got annihilated. Margin calls, forced liquidation, weak hands shaken out in 7 trading sessions. But here's the thing about speculators. When they panic out, they eventually panic back in. And when they do, open interest expands again, and price follows. The lows are very likely already in, not because I'm bullish, not because I'm a cheerleader, but because the structure of the market just reset to levels we haven't seen in over 6 years. That's pattern recognition, not opinion. Now, let's talk about China, because this is where the story gets existential. Since 2020, approximately 6,600 tons of silver have drained from Chinese exchange vaults. That's a 90% draw in 6 years. 90%. That's equivalent to 30% of annual global silver supply just disappearing into the second largest economy on the planet. The Shanghai Gold Exchange, plus the Shanghai Futures Exchange, hold a combined approximately 850 tons of silver right now. After today's draw of approximately 73 tons, there are 11 more days like this until there is no silver left. Not low silver, not tight silver, no silver, zero. Chinese buyers are using this price collapse to stack physical at a rate that is mathematically unsustainable for the Western paper market. This situation may push global gold and silver into a serious state of out of control. Those aren't my words. That's the translation from Chinese financial analysts watching their vaults evaporate in real time. Let me tell you about the cycle of collapse, because this has happened 3 times before in recorded history. Same pattern, same sequence, same outcome. First, the Roman Empire. For 500 years, Rome controlled the known world. Their currency, the denarius, was the global reserve. Merchants from Britannia to Byzantium trusted it. Then the emperors discovered something. They could shave silver from the coins, replace it with cheap base metals, keep the difference, fund their wars, pay their debts. At first, nobody noticed. 1% less silver, 2%, 5%. But by the time of Emperor Gallienus in 260 AD, the denarius was 95% copper with a thin silver wash. Bread prices that had been stable for generations exploded. Soldiers refused to fight unless paid in gold. The borders collapsed. Barbarians poured in. Rome fell not to external enemies, but to internal debasement. The empire died because they destroyed their own currency. Verified. Second, the Dutch Empire. In the 1600s, Amsterdam was the financial capital of the world. The Dutch guilder was trusted everywhere. Dutch ships controlled global trade. Then came the wars. War with England, war with France, war with Spain. Wars cost money, more money than tax revenue could cover. So the Dutch did what empires always do. They borrowed, they printed, they inflated. The Bank of Amsterdam, once the most conservative institution on earth, began issuing receipts for gold that didn't exist. Paper multiplied while metal stayed fixed. When people finally demanded their gold back in 1790, the vaults were empty. The bank collapsed. The guilder collapsed. Dutch power collapsed. The empire that ruled the seas for a century was gone in a generation. Not because they lost a war, because they lost the trust of their currency. Verified. Third, the British Empire. At its peak in 1913, the British pound was the undisputed global reserve currency. The sun never set on British territory. Then came World War I, then World War II. Britain borrowed from America to fund both wars. Debt exploded from manageable to catastrophic. In 1944 at Bretton Woods, Britain fought to keep the pound as the world reserve. They lost. The US dollar backed by gold became the new standard. Britain spent the next 30 years in managed decline. Rationing, devaluation, the 1967 pound crisis, the 1976 IMF bailout. By the time Margaret Thatcher took power in 1979, Britain had gone from empire to economy smaller than Italy. They didn't lose the empire in battle. They lost it in debt. Verified. Now let me show you where we are. Same pattern, same sequence, same outcome. The United States dollar became the global reserve currency in 1944. For 80 years, the world trusted it. But here's what's happening right now that nobody wants to say out loud. The U.S. national debt is $36 trillion. That's 133% of GDP. Interest payments alone are now over $1 trillion per year. That's more than the defense budget. The government is borrowing money just to pay the interest on money they already borrowed. This is not sustainable. This is not a political opinion. This is mathematics. When your interest payments exceed your discretionary spending, you are functionally insolvent. The only question is how long you can keep the illusion going. And here's how they keep the illusion going. The Federal Reserve creates dollars out of nothing and buys treasury bonds that nobody else wants. That's called monetizing the debt. It's a technical term for printing money to pay your own bills. Every empire in history that did this collapsed. Rome did it. The Dutch did it. The British couldn't do it because they were on a gold standard, so they just borrowed until their creditors cut them off. But America can do it because the dollar isn't backed by anything. It's backed by trust. And trust, once lost, doesn't come back. Here's the part that should terrify you. We are not at the cliff. We have already walked off it. The only thing left is the fall. Let me show you the signals that the smart money already knows. In the last 3 months, central banks around the world bought more gold than any 3-month period in recorded history. China, Russia, India, Turkey, Poland, Singapore. Even countries that were traditional U.S. allies are diversifying out of dollars and into hard assets. Why? Because they see the same pattern we see. They've read the same history books. They know how this ends. Here's what it looks like when a reserve currency collapses. It doesn't happen on a Tuesday at 3 p.m. with an announcement. It happens slowly, then all at once. First, international trade moves away from the dollar. Countries start settling oil contracts in yuan or rupees or gold. That's already happening. Saudi Arabia just joined the BRICS payment system. That was unthinkable 5 years ago. Second, inflation spirals. Not 2%, not 5%, double digits, then triple. Groceries double in price every few months. Savings evaporate. Pensions become worthless. This is what happened in Weimar Germany. This is what happened in Argentina. This is what happened in Zimbabwe. This is what happens when governments print their way out of debt. Third, social collapse follows economic collapse. When people can't afford food, they riot. When they riot, governments crack down. When governments crack down, freedoms disappear. This isn't a prediction. This is history on repeat. Same pattern, same sequence, same outcome. Now, let me bring this back to silver because this is where the mathematics become unavoidable. Silver is the most undervalued hard asset on Earth relative to the money supply. In 1980, when silver hit $50 per ounce, the US M2 money supply was $1.6 trillion. Today, M2 is $21 trillion. That's 13 times larger. If silver simply kept pace with money printing, it should be at $650 per ounce right now. It's at 78. That's not a market, that's suppression. And suppression works until it doesn't. Let me show you why suppression is ending. The COMEX is the price-setting mechanism for silver in the Western world. It's a futures exchange where paper contracts trade against a much smaller pool of physical metal. For decades, the ratio was manageable. 20 paper ounces for every 1 physical ounce. 30 to 1, even 50 to 1. But here's where we are today. March 2026, open interest is 429 million ounces. COMEX registered silver inventory, the silver actually available for delivery, is 103.5 million ounces. That's a ratio of 4.15 to 1, and it's falling every single day. In February alone, 18.72 million ounces were delivered out of 19.11 million ounces of open interest. That's a 98% delivery rate. That's not a futures market. That's a physical squeeze disguised as a futures market. January deliveries were even worse. 49.4 million ounces delivered. That's 7.27 times the 2024 level. The drainage rate is 785,000 ounces per day. At this rate, the registered inventory will be completely drained in 131 days. But here's the problem. March 1st, notice day is in 21 days. If even 50% of March contracts stand for delivery, that's 214 million ounces of demand against 103 million ounces of supply. If 70% stand, that's 300 million ounces of demand. The math doesn't work. It's physically impossible. So what happens when the math doesn't work? 3 options. 1, the COMEX changes the rules. They've done it before. In 1980, they declared silver markets were in liquidation only. You could sell, but you couldn't buy. That killed the Hunt brothers squeeze. But that was 1980. The world was different. If they try that today with international players like China involved, it destroys all remaining credibility in Western commodity markets. 2, the price explodes to balance supply and demand. If there's not enough silver at $78, the market will find the price where there is enough. That could be 150. It could be 300. It could be higher. Market's always clear. The only question is at what price? 3, they default. They admit they can't deliver and settle contracts in cash. That's the nuclear option. That's the moment when everyone realizes the emperor has no clothes. That Western price discovery was fake. That physical metal was already gone. And here's the terrifying part. All 3 options destroy confidence in the system. If they change the rules, trust is gone. If price explodes, the dollar's purchasing power is exposed. If they default, commodity markets lose all legitimacy. There is no good outcome here, only degrees of catastrophic. Now let me tell you about the silver miners, because this is where the real wealth transfer happens. In the 2002 to 2011 bull market, silver rose about 300% from $4 to $13 at its peak in 2011, actually hitting $49. But let's use the sustained highs. The average silver miner rose 3 times that. Some, like Pan American Silver, rose 1,500%. That's 5 times the metal's gain. That's the leverage of mining equities. When the metal moves, the miners explode. But here's what happened in 2025. Silver ripped from $20 to over $120. That's a 600% move. The miners barely kept up. Some matched silver's gain, some underperformed. Why? Because analysts were still pricing in $35 to $40 silver in their models. They were driving by looking in the rearview mirror. But that's about to change. This month, the big silver producers start reporting earnings, and those earnings are going to be biblical. Imagine a producer that mines 10 million ounces per year. At $30 per ounce with costs of $20, they make $100 million in profit. At $80 per ounce with the same costs, they make $600 million. That's a 600% increase in cash flow from a 167% increase in silver price. That's operational leverage, and analysts can't ignore it. When analysts upgrade price targets based on actual earnings instead of outdated models, institutional money flows in. Pension funds, hedge funds, index funds. They don't buy silver bars, they buy mining stocks because they're liquid and they trade on exchanges. And when that money flows in, the miners don't go up 20%. They go up 200%, 500%. We've seen this movie before. Agnico Eagle went from $40 to $300 during the gold bull market. That's a 750% gain. And gold only went up 300%. The leverage is real. The question is whether you're positioned before it happens or after. But here's the honest risk assessment, because I'm not here to sell you hopium. Bitcoin's technical structure suggests we might not be done with volatility. Every major Bitcoin bear market over the last 14 years has seen drawdowns of at least 75% from all-time highs. 93% in 2011, 84% in 2015, 83% in 2018, 76% in 2022. The polynomial trend shows each successive bear market getting shallower, but the next projected trough still points to approximately 70%. Applying that to the current cycle, 70% down from the highs would put Bitcoin at 38,000. Right now it's at 70,000 after bouncing 11,000 in one day. If history repeats, we could see another 45% drop from here. Why does Bitcoin matter for silver? Because they're correlated. Not perfectly, but directionally. The silver-gold ratio tracks Bitcoin. When Bitcoin falls, risk assets fall. Silver is a monetary metal, but it trades like a risk asset in the short term. So if Bitcoin has another leg down, silver probably goes with it. Not because the fundamentals changed, but because deleveraging doesn't care about fundamentals. When margin calls hit, everything gets sold. So here's the unresolved tension. Did we just see the bottom at 65 with a 22% bounce confirming the low? Or is this a relief rally before the next leg down? Let me give you both sides. The bull case. COMEX open interest at lows not seen since 2018 says speculators are washed out. Lease rates at 6.1% say physical is tight. China's vaults are 11 days from empty at current drainage rates. Backwardation continues. March delivery math says shortage in 3 weeks. The structure is set for an explosive move higher. The bear case. Bitcoin could drop another 45% based on historical bear market patterns. If that happens, silver gets dragged down again. Deleveraging events don't end until something breaks, and we haven't seen the break yet. We've seen a bounce. Bounces happen in bear markets all the time. Here's my read. The long-term bull market in precious metals is intact. Gold's parabolic structure hasn't broken. The monetary fundamentals are stronger than ever. Debt is accelerating. Money printing is accelerating. Geopolitical risk is accelerating. All of that supports hard assets. But short-term, we could see more pain. Bitcoin's technical setup suggests it. The violence of the initial crash suggests leverage positions haven't fully unwound. So what do? If you're a trader, you wait for confirmation. You watch Bitcoin, you watch the silver-gold ratio, you wait for a base to form. If you're a long-term holder, you use this volatility to accumulate at better prices. You understand that 47% crashes are gifts, not disasters, when the underlying asset is being systematically drained from global inventories. Here's the perspective that matters. In mid-December, silver was at $65 with an RSI near 80 and everyone was euphoric. Now we're back at 65, but RSI is 30 and everyone is bearish. Same price. Inverted sentiment. The people who sold at 65 in December missed the move to 120. The people buying at 65 today might catch the move to 200, or they might see 50 first. Nobody knows. But the people who understand the structural shortage don't care, because whether silver bottoms at 65 or 50 or 40, it's going to triple digits and beyond when the COMEX breaks. And the COMEX is going to break, not might. Will, mathematical certainty. Let me paint the picture of what the break looks like. It starts with a delivery notice that can't be fulfilled. Maybe it's a Chinese bank. Maybe it's a sovereign wealth fund. They stand for delivery on 10 million ounces. The COMEX doesn't have it. They offer a cash settlement premium, 5% overspot. The buyer refuses. They want metal. The COMEX offers 10%. The buyer still refuses. Word leaks. Other contract holders panic and stand for delivery too. Within 48 hours, registered inventory is claimed in its entirety. The COMEX suspends silver trading. Emergency meetings happen over the weekend. On Monday, they announce a cash settlement at Friday's closing price plus a 20% premium. But spot price in Asia is now 40% higher because everyone knows the Western market just failed. That's the moment when price discovery moves from New York and London to Shanghai and Mumbai. That's the moment when premiums on physical explode. That's the moment when you can't buy silver at any price in the West because it's already gone. And that moment is not theoretical. It's mathematical. When you have 429 million ounces of claims against 103 million ounces of metal, and delivery rates are running at 98%, the break is inevitable. The only question is timing. And timing is measured in weeks now, not months, not years, weeks. Here's what you do with this information. First, understand your time frame. If you're trying to trade the next 2 weeks, you're gambling. Nobody knows if we've bottomed or if Bitcoin drags us lower first. If you're positioning for the next 2 years, this volatility is noise. The structural shortage is real, the monetary crisis is real, the empire collapse is real. Same pattern, same sequence, same outcome. Second, hold physical, not paper, not ETFs, not mining stocks as your only exposure. Physical metal that you control. Because when the break happens, paper promises are worth exactly what they're printed on. Nothing. Third, position in miners for leverage, but understand the risk. If we get another deleveraging wave, miners will get crushed again before they moon. That's the nature of leverage. It cuts both ways. Fourth, watch the signals. Bitcoin at 38,000 would be a major confirmation of more downside. COMEX registered inventory falling below 80 million ounces would be a major confirmation of imminent shortage. Lease rates above 7% would confirm extreme tightness. China vaults hitting 0 would be the point of no return. These are the tripwires. Fifth, ignore the noise. Mainstream media will tell you silver is crashing when it's down. They'll tell you it's a bubble when it's up. They'll never tell you about the COMEX inventory. They'll never tell you about Chinese vault drains. They'll never tell you about lease rates or backwardation, because their job isn't to inform you. Their job is to keep you calm while the system collapses around you. This is not financial advice. This is pattern recognition. This is history repeating. This is the mathematics of a market that doesn't add up. Do your own due diligence. Understand the risks. Volatility will continue. Bitcoin may have another leg down. Silver may retest lower levels. But the long-term trajectory is set, not by me, not by sentiment, by the fact that 429 million ounces of claims exist against 103 million ounces of metal, by the fact that China has 11 days of inventory left at current drainage rates, by the fact that lease rates are 6.1% and rising, by the fact that every empire that debased its currency collapsed. Rome, the Dutch, the British. America is next. Same pattern, same sequence, same outcome. We are not at the cliff. We have already walked off it. The smart money is leaving paper and moving into physical. Not might happen. Will happen. You can't unsee it. This is a wealth transfer. It's happening right now, and it will be the largest wealth transfer in human history. From those who trust the system to those who understand it's already broken, from those who hold paper promises to those who hold physical metal, from those who believe the recovery narrative to those who recognize the collapse pattern. 21 days until March 1st notice. 11 days until China's vaults are empty at current rates. 785,000 ounces draining per day. 98% delivery rate. 6.1% lease rate. 429 million ounces of exposure. 103 million ounces of supply. The math doesn't lie. The pattern doesn't lie. History doesn't lie. Only the people telling you everything is fine are lying. This is mathematical certainty, not opinion, pattern recognition. The pattern says the break is coming. Be ready.